Good day, guys. Today we'll be discussing ICT Pd Arrays and invalidations. Now, there are different types of ICT Pd Arrays. In this video, I'll be discussing them. I'll be showing examples and illustrations on how to use them, their invalidations and their entries. Now, Pd Arrays, price delivery arrays, are levels price draws towards or uses to execute orders during institutional order flow. We have multiple Pd Arrays in ICT concepts. We have a fair value gap, highs/lows, rejection block, inversion fair value gap, order blocks, breakers, mitigation block, and volume imbalances. Now, some of these PD arrays can be used as entries and some are just used as targets, like highs and lows. They mark them out mostly as buy side liquidity or sell side liquidity during price action. Now, fair value gaps, these are inefficiencies between 2 points in price action. A bullish fair value gap is considered sell side liquidity, buy side inefficiency, and a bearish fair value gap is considered buy side liquidity and sell side inefficiency. Now, a fair value gap is usually is gap between two lines or two candles in price action. So you can see this candle, between this candle and this candle, we had this gap here where there was no consolidation or anything. It was just a straight candle move downwards. So this part of price action is inefficient. This price is inefficient. So what we want price to do is to come back and make it efficient, then continue with his order flow, right? So during order flow, we want price to retrace into it, make it efficient, then then go towards the drawn liquidity or whatever. Now you can see on the order this thing on the after, you can see price used the fair value gap, it tagged into it and it sold. How did it tag into it? It filled up all the inefficiency the fair value gap had, right? It took out everything, all the gaps inside, but it does not always do this. Sometimes it just tags into it and then sells from there, but this time it's tagged into it and filled up all the inefficiency, made this gap efficient, then it sold from it. So that's how fair value gaps are in price action. And the invalidation for a fair value gap is usually the high of the candle. So for a bearish fair value gap, the high of the candle is your invalidation. So after price moves above it, then the fair value gap is considered invalid and cannot be used to sell anymore. Now our next PD array is inversion fair value gaps. These are invalidated/filled fair value gaps. They get retraced into and used as support or resistance during order flow. Inversion fair value gaps are invalidated fair value gaps basically. So it is like having a fair value gap, then turning it upside down and using it to buy. Now in this case, we have a bullish inversion fair value gap, right? So price bought into it, then price tried to sell, but it failed on that sell and then price invalidated it. How did it invalidate it? It took out the high of the fair value gap. So after it took out the high, we got a retracement back into the fair value gap as support. So we use it as support to buy back up. So the invalidation switches from the high of the fair value gap to the low of the candle of the fair value gap. So now the low of the candle of the fair value gap is used as the invalidation for this bullish inversion fair value gap. So yeah, that's it about inversion fair value gap. And then our next PD array is an order block. So a bearish order block is the last buy candle before a sell, while a bullish order block is the last sell candle before a buy. The 50% of an order block is referred to as a mean threshold. Now, a bearish order block is the last buy candle before a sell move. Like in the example over here, we can see that this is the last buy candle. This green candle is the last buy candle we had here. Then price sold from it, so it's changed the trend. Price was buying before, then it sold, it reversed. So after it reversed, what did price do? Price has to retrace back into that other block, then sell from there. Why does this type of action happen during price? Well, the banks create a buy order, they create a small buy order, then immediately they create a large sell order. So after they create a small buy order, then they create a large sell order. So the large sell order sends price selling like this. Then after they create this large sell order, what the algorithm does is it it traces price action back to the buy orders to close them at break even, then add more sell orders. So possibly you have an order block after if the first order block got created, right? So that's basically how order blocks work. And you can see the 50% of an order block is the mean threshold. So the mean threshold, when price tags the mean threshold, the algorithm is trying to close some of the buy orders in profit because the buy order was made at the open of the order block. So if price retraces to the mean threshold, it means it's closing at profit because that's some pips there. Now, most times we use the mean threshold during price action for precision. We use the mean threshold for more how will I explain this? For more precision in price action, right? So if the other block we're using is very large, we use the mean threshold. Like in the next example, I'll show you a large other block where you could have used a mean threshold. But yeah, that's basically it for other block. So the invalidations for other block is at, for a bearish order block, like the example we have here, is at the high, the close of the order block. Our entries are the open of the order block. So our entries are the open of the last buy candle before the down move, and our invalidation is at the close of the last buy candle before the sell move. Here price tagged into an order block, it tagged the mean threshold without tagging the invalidation because that's where the invalidation is, right? And then it sold from there. So if price had tagged into this invalidation, then we would have had, if price had tagged into this invalidation, they would have had a invalid order block, right? Then it would be a failed order block, which we would explain in our next slide, where we have breakers. So breakers are simply failed order blocks. During order flow, a bullish breaker allows sellers of a bearish order block to mitigate their losses. Now, in this example, we have a failed bearish order block that switched to a bullish breaker. So it was a bearish order block, then it switched to a bullish breaker. Why? Because it got filled. Price it failed to sell price action, right? It failed to sell price when the level got tagged. So now after this failure happened, after this order block failed, these two buy candles on 15-minute time frame, which on the 30-minute time frame they are one block, right? So this type of order block, if you were going to use it to sell, you would have used the mean threshold. So you mark this middle and then you'd have waited for a retracement back in there, then sell. But in this case, it failed. So after it failed, what are we getting? We're getting our entry at where? At the close. At the bullish order block, your entry is at the open of the other block. But now we're having our entry at the close. Why? Because it is turned around, it is inverted, it is flipped, it is filled. So the other block has filled, and that's why we're having our entry at at the close of the order block. So bearish breakers are filled order blocks. It's just simply as simple as that. So you use them after another block has filled. Immediately other block fills. And most times bearish breakers create another order block like we have here. This order block is going to send price to buy up. So these types of order blocks are usually high probability. There are other blocks that got created by a breaker block. So that's order flow happening, right? The money came from them trying to sell here. They failed to sell. Then they mitigated their sell orders here. Now they are buying. So now they are mitigating this sell order that they had here. They are mitigating it here, and now they are buying more. So it is like a very simple move that you don't need to overcomplicate when trading. Just know that if you are anticipating a high probability order block to work and then it got filled, you can use that order block as a breaker. So now our next Pd array is mitigation blocks. So these are nearly similar to breakers, but they aren't. Mitigation blocks are formed after a failure swing in price action. So a failure swing is when price fails to do a read or a total soup or a Judas swing above the old high. So this is a failure swing right here, right? So price bought, it wants to switch to a sell, right? But instead of it to do a move above this, it didn't do that. Instead, we got this failure instead. So when we have a failure swing like that, we always expect this type of price action. we always expect this type of price action. We always expect price to use our mitigation block as our entry. So our mitigation block is almost like a breaker, right? But it isn't a breaker, because a breaker would have been a bullish order block, right? Or it would have been a bearish order block, or it would have been an order block that failed. But in this case, this isn't an order block that failed. It just got created while price had the failure swing. So price failed to go above this high, and then it got created, and then so it is the last down candle before this up move. Then after the up move happened, immediately we had a sell. After the sell happened, we had a retracement into this last up candle. So it could have been a bullish order block. Why? Let's see. If you have watched my previous videos, you understand total soup and you understand what I'm about to explain now. I explained this in the ICT total soup video. I'm going to leave you a link at the top corner there, so you should watch that. So what I explained was price would do a raid, right? That's total soup. Then price would tag into this other block, then buy from there. So now that it has failed, right? It failed to do that total soup order block move, but we know this order block is a high probability order block. There's a high probability it was going to work, right? What we're going to do is, after it failed, we'll wait for an entry back into it and sell from it. Like I explained in the previous slide, where I was explaining breakers, almost similar to breakers mitigation block. So mitigation blocks happen like this. You move up, down, then we get, this is where the mitigation is happening, and then we sell from there. So that's how mitigations happen, and that's what is happening in this chart. So mitigation blocks are, to use a mitigation block for an entry, use the close of the other block as your entry, and invalidation will be the open of the other block. Unlike when it is a bullish order block, where we would have used the open as the invalidation and the close as our entry. So here we have the last down candle before a up move, then it got invalidated. Now I'm retracing back into it to sell. So now that's a mitigation block. Why is it a mitigation block? Because it had the failure swing. So our next slide will be explaining rejection blocks. Rejection blocks, these are other blocks in form of a swing point. It's a high slash low and an order block at the same time. Rejection blocks are other blocks with more wicks than candle body. So rejection blocks are mostly found at the swing points during price actions. So you might sometimes be looking at the chart and you see a swing point happen. It happens like this, 1 2 3. So you can see this is the first candle, second candle, third candle. So 1 2 3 indicates a swing point. That's a that's a low forming, right? When three candles open, like when three candles are like this during price action, that's a low forming. Yeah, this is an high forming, 1 2 3. So this is an high, but in this case this is a rejection block. Why? Because it is the last candle before the buy move. Now you might be saying it is showing a green candle, right? So you might be saying, oh, it isn't an order block at all, because it is showing green color, meaning it's a bullish candle, right? But it is in fact an order block. Why? Because in this candle, more bearishness happened than bullishness, right? This candle sold from this high down to this low before it closed down here and gave us this small bullish move. So it was more of selling than buying, right? It has more wicks than body. So in this kind of candles, your entry is usually the open of the candle, then your invalidation is a low. Unlike other blocks where your entry will be the open and your invalidation will be the close, on rejection blocks your entry will be the open of the candle, then your invalidation will be the low of the candle. And you can use the 50% after marking, just like other blocks. You can mark from the high to the low and use the 50% as mean threshold for more precision in your entries. Now our next example are highs and lows. So these are swing points in price action. They are mostly marked as liquidity during order flow. What I'm saying here is that when we are trading price action, when we are trading, we mark highs and lows as our targets. That's our drawn liquidity. We mark them as liquidity when we are trading. So these swing points are usually marked as liquidity during order flow. A high would be tagged buy side liquidity, like I said, and a low would be tagged sell side liquidity. So a high, we can have relatively equal highs. We can have just a single high. So a high is 1, 2, 3. These three candles forming. So when you have a candle form like this, when you have a candle form like this, that's an high. When it forms 1, 2, 3, that's an high. And when it forms 1, 2, 3, that's a low, right? It is reversing upward, that's a low. It's reversing downwards, that's an high. So you can use these highs and lows as targets during price action, right? They don't really have an invalidation because they are mostly used as draw liquidity when trading. So you use them as liquidity, or when you want to take a third soup entry, you use them as third soup. But then your third soup still has to tag another PD array for it to actually work, or else it will just be priced during a break of structure, a market structure shift. Now our next and last slide would be volume imbalances. This is a gap in price action that occurs due to intense buy or selling pressure. When volume imbalances form, it's usually an empty space. There are no wicks or candle bodies in this gap, unlike fair value gap where the body of a candle is the gap. Now, what I'm saying here is, look at this illustration down here. It explains itself. So you can see in the fair value gap, like down here we have a fair value gap, right? You can see that this body of candle is showing there, price retraced into it, then sold. But in this volume imbalance, you can see just wicks are in there, and in fact sometimes there are usually no wicks in there. It will just be a pure gap between price action. Now the volume imbalance you should actually be using during price action is the one that happens after another block is formed. So when you use a volume imbalance after another block is formed, it means the selling pressure was so high that it had to sell even more gap. So it happens during like high market impact, stuff like that, or during a new week opening, or a new day opening. Those are the times where we see most volume imbalances. Now in this chart we have a volume imbalance on daily time frame, right? So we use it as this state. So the invalidation for a volume imbalance is related to that of a fair value gap. You use the high of the candle, that formed as your invalidation. So your high, this is the last candle that gave us the volume imbalance. So the volume imbalance is between this candle and this candle. So what we're going to do is we'll mark this gap from the beginning of the gap to the end of the gap. We'll mark it as our um, entry. So anywhere in between that, we can enter from that. Then our invalidation will be the high of this candle. So here is a bullish example again to show you more about volume imbalances. This example here, you can see we have the last down candle before a buy move. You can see price retraced into it and bought. You can see the gap between here. So there's a gap here, there's a gap here. It's usually, the gap is usually somewhere where there is no um candle body. There can be wicks in it, but there will be no candle bodies, right? Like now you can see there are wicks in here, but there are no candle bodies. So that's when you use it as your entry, right? Your invalidation will be the low of the candle carrying the gap. So the gap is between this candle and this candle. So your invalidation will be the low of the last candle of the gap, and you would enter from the retracement that happens in there. Now price can use this multiple times. It can even invalidate the volume imbalance. Then you still use it as a volume imbalance, right? It can come down here, invalidate it, then you wait for price action to retrace back into it and use it as a sell order. So yeah, that's basically it for today. I hope to catch you guys on the next one. Please like, subscribe, and share with your friends. I would include the Discord link down in the caption. You should join the Discord for you to see me execute my trades live and join my community in trading. And my Twitter is also linked in the description. You should follow me on Twitter for more updates and examples on the types of trades I take. And I hope to catch you guys on the next one. Bye.